S&P explodes off three major macroeconomic events. We're going to cover them. Nasdaq follows suit, but the Russell 2000 outperforms. We're going to explain why. The dollar plummets. Bonds are being bought at the fastest rate in years. The VIX is imploding at a rate not seen since the pandemic. Why there is virtually no chance of a rate hike in December. Smart money, dumb money. The current movement and what it's telling us. How the dot-com boom is very similar to now. We have a ton to go over. Let's get to it. Hey everybody, welcome back. So we can see the neckline right there, exactly where we stopped at the 43.76 level. A solid week. People aren't used to the market actually going up, but here we are. Friday was a little light right into that neckline and to this DTL, but there's a couple things that happen here that I think are worth noting. First and foremost, you should be able to see this pretty clearly with this downward trend line. You can see right here, and you can see that you're flipping it very clear. I don't think there's much more to say about that. Here it is. And then you can kind of see the back end of it. We've been talking about that back end for some time. So we know that we're in this range. We know that we're popping out of it. More importantly, if we just do the simplest of indicators and just overlay a 12, a 22, and a 55, we will see very clearly that we got to the 55 and then we halted. That's not overly surprising to me, even on our first attempt. Why? For us, 55 is where institutions have their interest. Some people use a 50. You should use whatever you're comfortable with. But when you look at that and how you're acting, is that really that shocking that the first time you're touching this level going into the weekend where you have all these geopolitical conflicts that people are going to say, hey, I'm going to take my profits, I'm going to get out of the way? No, there's three main drivers on why this market went higher and why it may continue to go higher. There was a massive shift in policy this week, not only in the US, but also in Japan. There's one that's rumored, and we're going to talk about three things that absolutely have changed the landscape this week, and it's irrefutable. Now, when I say it's irrefutable, I don't guarantee that the market's going up. That's not what I'm saying. What I'm saying is there are three main drivers of every single market. You have a macro driver, you have a fundamental driver, and you have a technical driver. Now, when you're sitting on your stool and you're trading, there are ways that sometimes we're leading more technically, more fundamentally, or more macro. Right now, you have three huge macro headwinds that are changing the landscape and changing the sectors that you should be looking at. We're going to dive into this. We have a lot to go over. The similarities between what's happening now, in my opinion, what happened in 1998. We're going to dive into that, and there's really a litany of stuff that we have to go over. So the way that we're going to cover this is we're going to cover these topics broad, a little in depth. There's a lot here, so let's just jump right in. So first and foremost, if we take a look at this on the weekly, we can see the 55 on the weekly. We got to that, touched it, and then bounced off it. I like bars like this when you're encompassing a bunch of other weeks within one bar. It says a lot. It says that you have that kind of massive demand. Now, there's a whole group of people out there who say, well, it's not enough. It's 1 week. It's this, it's that. I'm not going to make that debate that we're just going to miraculously go up and everything's going to be rosy. That's not what I'm saying. I'm going to be really clear about that. What I'm saying is that the landscape has changed a lot. Besides the economic data, which we will dive into, we do need to be aware of some things, and I will cover this more on Monday's video, but on your 4-hour chart, you are grossly overbought. Now, technicals can stay like this for a very long period of time when you have a macro shift. That's what's so important about this process and for people to get this when we start talking about the stool. And I really don't have a better way to explain it except that this is exactly what it is. When you're trading, if you're just focused on the technicals and you're looking at trend lines, macro can make technicals, you can go through them like tissue paper. Okay, that's how you get crashes and rallies that people do not understand, because they don't understand that there is an actual macro event, an event in the world that actually changed the entire landscape of how risk is calculated. That's what I think people are sorely missing here that are not tracking the bond market, not tracking the right sectors, and we will dive into that. The important lesson that you take from here is that we are overbought by any metric, and there is no other way to say it. So what does that mean for your trading? It means that when we're trading this week, we have to understand that we're trading in an overbought environment. That's what it means. And that means what? That means that anything that you're buying right now probably should be rented, shouldn't be owned. In other words, you're going to want to move fast. You're going to want to make your money, get in, get out. It's that kind of market. I know people on Friday were very frustrated with trading. When really all you needed to do was just kind of get in there and ride the wave and let it happen, because it's a position shift that you're witnessing. That's why it traded the way that it did. But if we look here through all of 23, you've never been higher. Now, there's a bunch of reasons for that. We'll address some of them in this video. We'll get into more during the week. But just understand that we really are at that peak level on the 4-hour. overbought. It doesn't mean you're going to go down. It does mean that after a while, you may go sideways and work it off. You might go sideways and then come down a little bit, retest a level. I don't know that you're going to see major drops like this unless we get more economic news that changes the landscape or macro news that changes the landscape. But I don't see how that's feasible. There's three things that happened. And the one wild card to me is just what's going on with the economy. Yes, it might get worse than we think it is, but is that going to happen in the next 8 weeks before the end of the year? I'm not sure on that. And then we have to look at the geopolitical events that are going to be an issue. But here we are in the NQ, the Nasdaq. We're already over the 55. Now, you're going to see that I'm going to spend some time on technicals on the indexes, but not as much. And the reason for that is they're going to change. And they're going to change. Don't make me bring the stool out again, but like they're going to change because all the pieces are moving, right? They're all changing. So you have to look at this exactly how these are. And thanks, Steve, for making these. It makes my life easier. Okay, you have a lot of moving pieces right now that are changing. So we're going to look at technicals, and then people are going to point out, well, there's this technical, there's that technical. Okay, the entire structure of the bond market and people and the players change this week. And there are reasons for that. And we must accept that. And if we get that part of the puzzle, it's like doing the edges of a puzzle and then you go into the middle. Life's going to get a lot easier for this week and you're going to understand why certain sectors are rallying. We're going to get into that. But if we focus on what's happening here, you're at a perfect level. We know that we can clone these and just drop them in, and you can see that level right in here. I'd actually like to go back to right in here and show it. So you can see how we popped out of it and then we're back in. So you're in this perfect range. Let's extend that out just a little bit. So you're in this perfect range right here. You were at the bottom of it, you're at the top of it. And I just think it's pertinent for us to point out the obvious here that you never broke. And now what we're starting to see is we're starting to see this rally. All right, so we understand that the indexes are shaping up. And we also understand that they are overbought. They are two things that let's clean all this off. There are two things that you must really understand about this market. Okay, that you are overbought, extremely overbought. If we go back to 2023 and just look at the times that we've been this overbought, and you can see exactly how we've acted in here and how that's playing out. So this is something that we have to watch very carefully and be very diligent about. Again, the technicals in and of itself, in my opinion, are going to change fairly drastically and fairly quickly. And that's why I think that we should spend more time understanding what's going on under the hood and then kind of go from there, look at what stocks are going to move, which stocks are not going to move so that we can position ourselves. I'm going to show a couple live trades today, at least one while we're doing this video. But you see how you're holding that 50 right there and you bounce right off of it. I mean, this doesn't get any clearer that that's something that you want to watch. But I do think we need to talk about the three major drivers on what's happening and why it's happening. Now, the first driver here is going to be the Fed. And what's in front of us is CME tools. You can go to CME tools and do Fed watch. And what this does is this gives you target rate probabilities for December 13th Fed meeting. And what I'm showing you right now, please note the date down here is November 1st. Now you're going to see something absolutely fascinating here. But you see this data right here? Look at 28%. So the day before Powell spoke, and the day before the Fed meeting, you were at 28% chance that they were going to raise rates. Then you were at 22% after he was done speaking. Okay, just I want to be real clear about that. If you look at the time here, and you can even see the date here, and you're looking at this, that drop that fast is absolutely huge. To put it in perspective, here you are over 1 month to 1 day. So 30 days out, you only dropped maybe 1 or 2%. And then here, between 1 week to here, you dropped about 60 basis points, 70 basis, 50 basis points, something like that, right? We don't know what the hundreds are. It doesn't matter. So that's where we are right now. Okay, now he speaks and the bond market rallies substantially. That is the first driver, but let's look at what happened since he spoke. Now, since the speech, and you look at the date down here at the time of recording this, since this speech, we're now at 95.2% chance that rates are going to stay exactly where they are. What changed? If we take a look at this, what exactly has changed here in that period of time? There are two other catalysts that have changed drastically. We're going to go through those in a second, but I think there's a really important distinction here. He is never going to come out and say, we're going to absolutely never raise rates now to the end of the year. He will never say that. No Fed chairman has ever said that in history. And I think people are expecting something like that. It just doesn't work that way. So right now you're at a 95.2% chance. This is really dramatic because this is a massive change in a very short period of time. What changed between Powell's speech, which was the first driver of the bond market? Okay, that was our first driver. What's the second driver? What's the third driver? And why is this happening? Now, just to give another graph real quick, again, this is CME tools that I'm using. But if you take a look at this shows you current 1 day, 1 week, 1 month. And what I like about this is you can see where you're at, but you can also see the changes between now, one week, 1 month, and you can see how drastic it is, the chances of us actually going out there and raising rates. It's almost nil. It's done. Put a fork in it. It's not going to happen again. There's a lot of firms that have been saying this for some time, but this is abundantly clear that this is the way that we're going. Now, the site in front of you is Trading Economics. This was actually a referral by somebody that comes into our pre-market streams. So the public ones. So it's really important to get this. If you have a service and it's better than something that you see me using and it's free, let me know, because what I do is I try to use these free services so that people can find free links so that they're not spending money if they can avoid it. But this to me was really important, this Purchasing Managers Index. And I think it really got overlooked by a lot of people that don't understand economics. But you see where you're at this 46.5? This is a contraction level. And this is coming off of this 49, which really started to scare people a little bit because you started getting higher. You started coming into levels that you hadn't seen before this year. So when we had this huge move, and then you're seeing productivity go like this after we had this initial drop off of it, you can see that differential, I'm sure. But when you do something like this, then everybody kind of wakes up and goes, whoa, wait a minute. And they pay attention and go, oh, we are contracting. It's not going higher. We're not going higher. We're actually are contracting. Now, these headlines really underscore what's happening. So in other words, U.S. factory falls to least in 10 months. So this is from October. And you can see how all of a sudden that was a problem for us. Now, November is showing us that it's not a problem. We contracted more than expected. So there is a difference here. And they talk about it, 46.7 from the 10-month high of 49, which was the previous month. And you can see that data right here. Well below the expected of the 49. The data underscores the impact of higher borrowing costs from the Fed in the sector, furthering challenging resilience in U.S. goods of producers and other reports. The contraction in new orders accelerated 45.9 versus 45.5 versus 49.2 in September, pointing the 14th straight decline, with panels noting lowering demand from both domestic and foreign markets. Consequently, production slowed. You want this under 50. That's what you're looking for. Anything under 50 is contraction. Anything under 45 shows that you're heading into a recession. So that's why this number coming out, if you go back and you look at history, and I'm not going to bore everybody, but if you go back and go through history, when you're at a level like this, on manufacturing PMI, you are not raising rates, period. It is not happening. So the second piece of the second reason why we did what we did was non-farm payrolls. Non-farm payrolls were 180. Now, what was more interesting about non-farm payrolls is people are starting to realize that, and I'm going to just leave this out there and not put the tinfoil hat on, because I think every administration does it, quite frankly. The numbers are so skewed, it's ridiculous. So people are going back and starting to look at household numbers compared to the non-farm payroll numbers. Household numbers are another number that comes out that does not include if they are second or third jobs. And they're starting to go through those numbers, and they were abysmal. So in other words, non-farm payroll, which is usually looked at, people are going through the household numbers. We did this a month ago in a video. I'm not going to recap it all right now, but household does not take into account if these people have second or third jobs. Non-farm payrolls does not care. It just takes it all in and looks at it. And that's why you saw this. Now, a couple things about these numbers. Number one, we were revised down from the previous month. This was supposed to come in at 180. It came in at 150. What's important about this is one of the lowest readings of the year in comparison to where we were back here. This shows clearly that the economy is cooling. Now, there's a couple really key lines in here that I thought were interesting. But you're at 150. That's 295. You're about half of where you were supposed to be from before, and you're at this level. The report showed the labor market is cooling. Several strikes. Okay, we have the strikes that are going on. You're getting jobs in healthcare, hospitals, the government. Look at the government jobs. So look at the amount of government jobs that are feeding this right now. It's one of the strongest sectors that are out there. People are starting to realize that this number is being propped up by government jobs. I think that's a really important distinction. February construction, if you take a look here, 23K, assistance 19K, hospitality. On the other hand, employment and manufacturing declined by 35K. So people that are in manufacturing are losing their job, way more than forecasting of a 10K fall. What people are starting to do with these numbers, which is very rare, you usually do not dive into them and take them apart this much. And the reason people are doing it is because these numbers are becoming a little bit inflated by what's going on with the government. And so what they're doing is they're coming out and looking at it this way. All right, so there's your 10K fall, reflecting a 33K drop in motor vehicle and parts that was largely due to strike activities. Got it. Payrolls in October were also below the average monthly gain up to 58. Payrolls in October were also below the average monthly gain over the past 12 months, but remain well above the 70 to 100K needed. Listen to this wording, 7 to 100K needed per month to keep up with the growth in the working age population. All right, so what they're leaning towards here is that we may have a problem on the other side where we're not having enough jobs. See, bad data is good until it becomes bad. Just remember that. Now, everyone will remember this video if you've been with us for a while. On July 28th, we came out and talked about the reaction to Japan's monetary policy, where they changed their monetary policy. Japan owns $1 trillion of U.S. treasuries. They also have an issue over there where they have yield controls on what they're doing. They were talking about loosening those controls. That was July 28th. On July 28th, that is when we peaked on the market. We went and explained this. I'm not going to bring out the stool again, but we explained this and what happened and said, okay, this move in equities was predicated upon what was going on in Japan and what was going on in the bond market. So if you mark what happened on the ES here, if we go back and look at the Treasury and we look at the same exact time on the Treasury and say, okay, well, what happened to the Treasury during this time? And we just mark that same line here, you can see that all it did was rally until it went up 5%. All right, so we know that Powell has changed. We know that the data since Powell is getting worse on the economy side, meaning that we're cooling. Cooling means worse. They just changed the language. The vernacular will change as time goes on. By the end of 3 months from now, it'll be bad. Anyway, so then we saw that percentages drop and we saw that the data came out. The third leg of what's going on is Japan and what's happening here. And that's why we're seeing such a significant move, because you have three forces that are really driving us down here on that macro leg. So you can actually think about the stool and just think about the macro, actually that part of that stool having three legs. I'm not going to try to get too meta, but you get it. So here we're at, and what happened here? So here you have an article on October 31st, yen on intervention watch after hitting 1 year low on BOJ disappointment. People did not like what the BOJ did. And so the BOJ basically is coming out and saying, oh, we're going to do an intervention. Okay, we're going to do an intervention. So what happened there? Well, what happens there is that leads to what you're seeing happen here with the dollar. The dollar starts to drop. As the dollar starts to drop, you're going to start seeing the yen, right? The yen will rise. And what that will do puts pressure on the dollar. And then what it also does is it put pressure on our bond. So what you have here really for the bond market is a perfect storm. And it's really important to get this. You have three drivers out there. You have Bill Gross, who they brought out the other day, who arguably knows more about bonds than anybody in the world. And he's basically coming out there and saying, look, that's it. It's done. This is it. We've hit our peak and peak yields. And I think that's really important. I'm not going to bring up more articles. I just need people to get this concept that there's nothing technical that you're going to look at on a chart that's going to explain to you what happened. You're going to see a lot of people on social media and all over and say, oh, it's because of this XY indicator. And, we knew this was going to happen. You had three major events. You had Powell coming out and doing what he was doing. That was the very first event where he made it very clear that he was going to be dovish. You will note that we kind of moved that day, not really. So that was your first thing. Your second thing was the data that came out after that data. That would be your second thing that came out. Your third thing is Japan. In my opinion, if I had to weight those things, it's Japan. If your force gets you to rally and that force changes, that becomes the issue. And that's what you want to pay attention to. So what does all this mean? It means the following. It means the dollar is dropping and will continue to drop. It means people are going to buy bonds because they're realizing they're going to get rates on treasuries that they had not had for 15 years. The economic data supports what Powell's saying. And now you have Japan that is starting to wind back on their intervention. Let's look at how this is affecting smart money and dumb money. Now, one of the graphs we watch very frequently is smart money, dumb money. And we don't call it that. We call it institutional and retail. So we refer to smart as institutional and we refer to dumb as retail. And the reason for this is because how these are calculated. Now, if you've been with us for a while, you know this. If you haven't, just remember institutional and retail. Keep that in mind. Now, there's some things that are going on here that we really need to pay attention to, but we're going to start with the basics here. And what I want to do is just point out the very basics of how this system works. Blue is smart money or institutions. Red is dumb money, which we don't call it. We call that retail. Okay, now here's the most important part of this. Yes, we want to look at these lines and we want to pay attention to, are we oversold or overbought? We also want to look at them relative to what the market's doing. In other words, are we seeing some kind of shift or change? For example, you have a peak, and then you have this low here. And right in that low, then you get this high peak. And that just happens to denote what? That was the bottom of the market. So when you start to see these little changes, whether it's in smart money or dumb money, we really want to pay attention to it. In other words, here's another great one where you have a peak, and then you have a low, and then you have another peak. I'm going to clean this off and show this to you even clearer. Then we're going to break it out. But I really want you to get this because this is really important to me. And the more you study this stuff, the more you pick up these divergences. And divergences really are very good at telling you what's going to happen. It's just a question of when, right? See that? Do you have that dip? See how you don't have that dip? You're making that higher high. Even though you didn't make it here, you made it a little higher. So you can see that pretty clearly. And let's point out this one as well. So again, what we're looking for is these changes. And you're seeing it right here, right? You see that little one right there? And then what happens? There's your bottom. So you have that divergence right here that kicks in. And when you see that divergence, you have a little bit of a difference there, don't you? Now, I'll show this even clearer, and I'll show it one more way before I get into what's really fascinating all going on here. So we take this level right here, and we look, and we see that going straight across. Let's leave that in for a minute. Let's change the color of that so you can get what I'm putting down. See that? See that? Okay. All right. So not exact, but it's there. Now, what else are we noticing? Well, if we go over here and we take a look at how this is playing out, we note this area, and this area, and we see this dip. Well, we're going here, and then we're going here, right? So in one area, what do we have? We have a positive divergence. In the other area, we have a negative divergence. And what are they telling us? All right, let's break it apart now. Now, one of the core things that we're noticing, when we get to the top, we put in a bottom. That's true, but it's also true that when we make the turn, we're putting in a bottom. And I think that's a really important distinction. It doesn't have to be a full-blown top. In other words, let me show you. So if we're here and then we see these levels, let's just mark them off so we can see this pretty clear on where we're going with this. See how we're not breaking and you're still putting a bottom in? See how you didn't break, but the roll is what got you to put the bottom in? All right, see how you rolled and then you went higher? See how you rolled and you went higher only for a little bit? Rolled, went higher for a little bit? Look what you're doing now. And look at the difference here on how this is shaping up. So in other words, what's happening here? We're hitting a higher high here, and at the same time, we're hitting a higher high. What's happening? We're hitting a lower low. So if we drill into that just a little bit, you see that right there, and you see that right here? Let's zoom out. See how we're dropping? See how that rose? See how this dropped? See how this rose? Okay, see a pattern here? So when this is happening, it's setting us up for something like this possible. And when this is happening, it's setting us up to put the bottom in. Because when we roll down from these levels, the deeper the roll, the higher the rise. The deeper the roll, this is smart money or institutions, the higher the rise. I think that's a really important distinction. Institutions lighten up into rallies. Okay, that's what they do. They accumulate and then they lighten up into rallies. If they're lightening up, they're expecting this to continue to push. I know it's contradictory to how the people think that an institution's going to hold the whole time, but they can't. Most pension funds, by the way, that would be trading equities, they have assumptions. So let's say their assumption is, an 8% line. Right? And let's just say it's an 8% line. And then we're looking at that 8% line. If they come over and they're at like 12% assumptions because the market's going up, well, then they'll sell a portion of their equities and then they'll buy a portion of their bonds. I know that's really crude, but hopefully you got it. Now that's an important distinction. What type of effect do you think smart money confidence is going to have on what's happening in the bond market as their bond market portfolio starts exploding to the upside? Just something to think about. Now let's look at this the other way. Now, one of the core things that we're looking at here that is just absolutely glaring is every time that we peak right in here, we're putting on a top. This is not dumb money, but retail money, and you'll see these. But let's just pop them in. It takes a second, and it just becomes so glaring. All right, you get it? Great. Then you have another one here, and that's it. You have another one here, and that's it. Okay, what happens when they start hitting higher highs? Not lower lows, but what happens when they start hitting higher highs? we start going higher. Okay, so let's take all this off and let's look at it this way. What happens when these peaks start going higher? Well, this starts happening and we start going higher. All right, so as retail comes in and institutions sell to retail, the market goes higher. That creates more buying, that creates fear and greed, et cetera, et cetera. That just makes sense. Now, if we look at the market, well, there's something going on here very similar to what we just saw a little earlier. And this one's absolutely glaring. So you have a lower high, lower high, lower high on the S&P. And then as you come down from here, what's happening right here? So right here already we broke. You can actually look at this two different ways, depending upon how you want to. You could look at this as a divergence or that the dumb money confidence has already broken its DTL, downward trend line. So you could look at it that way, or you could, right? And then you're here coming straight across. I know it's rudimentary, but you get it. Okay, you already made the higher high here and you didn't make the higher high here. Clean them off so you can see what I'm talking about, right? You can see right here that this is lower than this and this is higher. Okay, so the other way to look at that obviously is to go here and here. Got it? So when we're starting to see this, we're starting to get the opinion that this is meaning that retail is coming in, institutions are starting to sell to retail because their assumptions are changing and they think we're going higher. I thought this was interesting. We have a bunch more to go over here, but I thought that this was really interesting to note. And what we're seeing is exactly what we'd want to see for a sustained rally. All right, so let's recap before we move forward here. We know a couple things. We know the three reasons, and there are three main reasons why we have ourselves in a position where we have a macro trade. We went through what those three are. Now, on top of going through those three reasons, we now know what smart money is doing, and we know what dumb money is doing. We're fully aware of how that's playing out. We're fully aware of where those lines are and how to play those lines, and we're fully aware of those divergences. So I think that that's pretty significant. So now we know what's happened and why it's happening. We know how institutions are positioning themselves, and we know how retail is positioning themselves. Now, let's just take a look at what's actually happening under the hood based upon this. So we have the 10-year, and then we're going to go into the indexes, then we're going to go into the stocks. And then I want to show you something eerily similar to the 90s. So we're going to bring this home, but we want to make this really actionable for next week. Now, if we look at how we're acting right in here, we are imploding on the yield. Now, I want to explain this so that you understand this really clearly. I'm going to leave that in. Right. So if you're up here and you're at 5%, and you drop to 4.5%, okay, that is a 10% drop in yield. Now, I took a little license there, but you're roughly around 10% on the drop in yield. Why is that important? This is why it's important. Right here. If you have yourself in a position where you have bond price and you're trying to figure out what the bond price is and you want to know what the bond price is, why would you care about this? You would care about this because this is how mortgages, REITs, banks, regional banks price their unrealized losses that everyone has become an expert on since March. This right here, this is how they do it. So if we have a bond price and you take 1% and you times it by the year to duration to get the bond price movement, not the price as well, but you want to calculate the movement. Why do you want to calculate the movement? Well, you want to calculate the movement here because you're just trying to figure out exactly how this is going to play out. Why do you care? You care because this is all we heard about was regional banks have all these unrealized losses on the books. Mortgage companies, REITs, commercial real estate, office real estate can't possibly hold all these mortgages and assets on their books. So what's happened here? You went from 5 to 455, let's call it. Okay, let's just call it 50 basis points. If we take 1% and you times it by the years of duration, this is a 10-year. Every 1% that you drop in yield, the bond price goes up 10%. If you drop 50 basis points, the bond prices just went up 5%. Okay, so why this is significant is the following. If you take a look at what's happened this year and just take January, let's go to the 1st of Jan, see where we are. So we're right here, all right. So you come here at 380 and you go and take a look, 480. All right, so you had a 36% or 1.2% movement in the bonds from here. Well, that's a huge move, right, than what you're realizing. And that means that they lost a huge chunk. This is just on the 10-year. That's not talking about the 30-year, the 20-year, and the longer durations. This is why the yield curve got so skewed, because they were losing so much money, regional banks. They had to buy the front end. They couldn't take the risk of the bond market anymore, and they're forced to buy treasuries so that they can have yield to pay people. That's why it got so screwed up. Anyway, if you take a look at how this is playing out, this rallied everyone's bond portfolio. This rallied everybody's real estate portfolio. And people were saying, well, why would it rally the real estate portfolios? Well, all of a sudden, you're realizing that you don't have unlimited risk to the upside. You realize that your risk is capped. If you don't think that your risk is capped right now, I would suggest you go back and watch the first part of the video where we talked about the 3 things that happened this week that have capped the 10-year. Yeah, I would really focus on that so that you get this, because what people are going to do is they're going to look at this technically and they're going to say, all right, based upon the technicals, the market might stop here, this might stop there. The technicals are not the trade. The bond market and the dollar and Japan's intervention is the trade. That's why we rallied here, all right? If you take a look at the past 12 months, in other words, if you took a look from here to October here, and you took a look from here in July, let's just mark July, right? From here over to where the bond market was, and you look at the movement in the past 12 months, no matter what the Fed did, okay, you moved about 20% in a year. From what Japan did, how much did you move? 31% in months. Do you think Japan had something to do with this? Yes. The answer is obviously yes. We've been going over this ad nauseum. So if you can see how we're acting in here, where we're going, you want to start watching these levels. How low do we go? That's where you might want to start looking at technical analysis and overlaying technical analysis. How low does this go? I don't have a clue. Where do I think it goes? I think it goes lower. I think it takes time, but everybody is out of position, right? You have the single greatest bond losses on government balance sheets, on pension funds, in retail portfolios that you have had in U.S. history. So everybody that's wanted to buy bonds has not been buying bonds. That's why the very first thing we did in the community was buy bonds. As soon as we understood this, we went and bought bonds. We started on Wednesday. And it made perfect sense to do, and we've done quite well with that trade. And you're going to see this also here. You have so much pressure here to buy bonds and buy equities and sell the dollar that we are literally gapping up in indexes. Look at IWM. Now, why is IWM moving more than anyone else? 15.9% of IWM is small regional financial services companies. No one benefits more. So why everybody's looking at tech, and I got it, tech's fun, we can see the breakouts, things like that, and we're going to talk about some individual names here in a second. That's fine. And I'm not saying to not look at tech. I'm not saying to not look at consumer discretionary. That's not what I'm saying. What I'm saying is that if you truly understand the trade and what's going on, that's where you're going to make significant money. Okay, and that's the important part of this. What do I mean by that? Well, let's just go through a couple of these names. All right. So here you have SPG. Now, this is a mall REIT. Okay. Here's Tuesday. Here's Wednesday. Look at this move. You're up 10% in a REIT in 3 days. Okay, maybe we're a little overextended. So what? I hope we are. I hope that gravestone rolls back down and we can start looking at these names. All right. There are names out there that are trading under book value. Book value on this is in the 60s. Why wasn't it going higher? Well, it started to go higher. Why did it come down? Higher for longer. Is higher for longer a thing? No, it's no longer a thing. Do you think Japan would be out here buying $2 billion, right, of 245 Park if they thought it was going to zero? No, they wouldn't have made this investment. You're still able to buy some of these companies for pennies on the dollar. And I really think that this is where people are going to make a lot of money if you walk through this. This is no different than when you watch people pick up banks and REITs in 2009, 2010, 2011. You can't be saying, I'm going to buy it today and I'm looking at getting out by Tuesday. We'll get into those names and how to trade them in a second. But understanding that names like FCA had record revenue and record earnings from when they bought these banks and were allowed to buy these banks. And same thing with NYCB. And that people are blowing these names out. This is where you're going to make your money. Understanding this and understanding all the interest rate bearing activities. Look at NAIL. Look at that trade and look at how that moved. You don't have anything like this going on in tech. And there's a reason for that. If you come here and take a look at this, you're up 38% on this 3X, SOXL. Have you moved? Yeah, you moved. Okay, you moved, and let's just take, Wednesday. All right, so you take Wednesday here, like, okay, yeah, you moved, but you were outperformed by home builders. Home builders, the 3X ETF in home builders is outperforming semiconductors with SMCI coming out with earnings, with all these earnings coming out. And we're not even talking about how the longevity of this yet is going to affect these names. Now, I think that home builders still have issues because you're going to hit a point here where if the economy slows down, people are not going to be able to spend $1 million on a McMansion and the way mortgages are structured. That's a conversation for a different time. What you have to realize is people are going to buy yield. Now, we bought this in the low 60s and it's done exceptional. And we're buying utility companies and this is happening. Now, where else should you think about where interest rates are going to affect? Well, if interest rates come down, right? Just walk through this. Interest rates, they drop, right? So the bonds drop, interest rates drop, mortgages drop. What happens with that? Dollar drops. All right, so the dollar drops. Okay, you see the dollar just absolutely plummeting after NFP. We've talked about this, those three reasons why. Okay, so what benefits the most from a dollar drop? Okay, conglomerates benefit the most. Names like Microsoft, Google, they benefit the most from a dollar drop because they no longer have currency risk. All right, they benefit the most from this. More people will go and buy their products. Who else? Industrials. See how industrials moved? All right, so Caterpillar didn't bounce because everyone realized that their earnings were good and they made a mistake. Caterpillar bounced because the dollar dropped. So you want to keep that in mind. I hope that's helpful. As far as individual names, you're seeing a lot of confusion. This was an excellent quarter on SMCI and people didn't get it. This provided a huge trading opportunity. Now, I read your comments all the time. I respond to them all the time. Sometimes it takes me longer, but I respond to each one. The one comment I get is all the time is do more trades, show more trades. Going to show a live trade. Some of the other comments were show where you've taken a loss. So what I'm going to do in this video is I want to show you where I read this quarter. I do a lot of fundamental reading on analysis of corporations when they come out. I thought it was good. I thought this was a solid quarter. And it was my understanding that we were at a base down here on the name. And I thought that we were maybe going to stop a little sooner up here and we didn't. But I want to show you how we took a loss, how that was combated. And then what we did with the loss was we turned it into a massive winner. And I want to show you how that was done here.
What is the best way to play this? You think you're going to reverse at some point today. What is the best way to play this? But my tens, where do they stay with? Holy, that's a heck of a spread. Look at that buying right here. Buy November 10th, 240s, options at 12. You can do stock too. SMCI by November 10th, 240s at 12. You can do it with the stock too. For now, it's a day trade. We might hold on to it though. All you're doing there is using that. You're using the doji. And then you're going to use the high of that doji. Right? That's your entry price to here, and that's how you can quantify your stop. So if you're taking risk right here, that's all you're doing. There's your risk. Call it $3 with slippage. So that's how you would set your stop. SMCI trade. I don't expect this to just miraculously go back up. I think you're going to come back down, possibly test, but that volume's insane. That's huge volume. I mean, it's the first green volume you've had in a 5-minute chart and you're completely oversold. I mean, look how oversold you are. And look at the buying down there on one bar. You never broke since that bar. So you have a buyer there. How long that buyer's there, I don't know, but I think that was a decent spot. Reduced. I'm going to hold half. Reduce those options loss. Looks like $3, $2.50 loss. I'm going to hold the rest. If you have stock, you should have honored this. Bought more of the 240 calls, paid $6.50 for them on SMCI. I used a $2 stop on the addition. Overshot. I think you overshot here because of how thin it is. SMCI, I paid $6 for those calls, $6.50. They're at $7.80. So I'm up on these, even where it's sitting right now, I'm at 6 by 650. It's actually going up in value. It's crazy. And the stock's not even doing anything. I think this would be a huge trade today. Huge trade today. We'll see. Options are $7. If you want to take them out, you'll make a little money, but I'm going to sit with them for now. You understand what I did. I trimmed, I took a loss of $2 on a very large chunk of them. Held some, bought the ones back when we did this, rallied up. I think this was it. I think this was your shakeout. Piper on SMCI with the second edition. Did you consider that a completely different trade? It's a completely different trade. It's a completely different trade of a completely different pattern. I just thought that they were playing. It seemed that way. It seems like I'm probably right, but we'll see. So now this is giving me something to work off with. If I want to do stock now, if I can get a close like that, that's giving me something to work off of. So if I look at those options now, they're $8, paid $6 for them. So let's see what happens here. See what we get. See if I can get that push that I want. See how that's going. And then you look at this SMCI. Let's go back to this, why I'm still live. This is why I wanted to stay. All right. So there's your first close since you broke over the 9. So you could use this right here, 232.55 if you're long stock. If you wanted to go long stock, this is where you go long stock. You have the 9 EMA coming up and you're sitting right there. This is where you would trim the options. Okay. If you wanted to trim the options, this is where you would do it. You paid 6 and change. They're at 775. This is where you hope that helps. All right. I think if it takes out the low of the day, you got to get out. I don't know that you're going to see the low of the day again, though. If you take out the low of the day, you got to go. Where do I think it can go? I think it could have a heck of a day if this market really turns around and does what I think it can do. You're going to want to watch this bar for sure, because if you form this doji right here and then you flip that doji, you got another 25 minutes serendipity, then you're going to want to watch this, right? So like if you flip that doji, right, you're going to want to, if it becomes a doji, if it's just a straight up hammer and you flip it, you can get back to here. Like this particular pattern, right? These are morning stars. It hasn't formed yet. We have 24 minutes, but 24 minutes that could. So what you would do is if this forms and then it flips, we have the potential it's not perfect. We have a potential morning star. Your target on morning stars are the high of where the red bar. Okay. So then my target could be 260 on that. All right. That's how I look at it. So, I mean, those options are at where are 850, 760 by 850. They got a spread you can drive a truck through. The opportunity was in the pullback, right? I mean, that's where the opportunity was. So I don't see the edge. Like the edge for me in this trade and adding to it was simple. That edge came from when we sold down here, that I could buy the options really, right? That's why I did that, right? And then we'll go from there. SMCI, still holding, and that's a gap shell right there. Nothing for me to do here, guys. It's still hang out. Let it do it and do what it's going to do. It'd be really simple too. I'll just use the low of that bar on the trade. Call it a day. That's just beautiful how that trade played out, isn't it? I'm going to cover it tomorrow. This SMCI is working out pretty nicely, isn't it? I'm not doing anything, guys. There's nothing to do. But this SMCI, I'm not doing anything, guys. Where are we now with those? We're going to be killing it on those, right? 8.6. Where are they? Oh, 24. That's nice. All right, look at that buy. Boy, did they make a mistake. Boy, did they make a mistake. I think it's worth waiting for that bar, even though it's going to cost me profit. I really do. Let's see what this bar does. You got to love $2 spreads on stock on options. All right, let's look at this SMCI trade. Let's look at what we were looking for. This is where you closed. It's 36. Where does that get us? I don't think we're seeing that today, but 280 is possible. Take a look at this hourly. What could we do? Ooh, got some room, guys. No, I know. 274 would be next, really. That's your neckline. As we've had the most battles, Sam. So let's watch that. See how that goes. SMCI. Where are we? All right. So I think I'm at that level where we're going to pull something out. I think we're going to wait for this. All right. So we're up 400% on that add 6, and we have a double if you're in from 12. So I'm going to pull out half of my remaining trade up here. Just put that out there, John. We're up 400% from the 6, and we have a double from the other. So I'm going to close half the remaining trade right here. And then I'm going to use a close below VWAP on the 5-minute for the remaining part of that trade. All right. Just put that out there, John, please. Thank you. That's about 27. So we're actually up more than 400%. Okay, I'll take it. So that's my trade. So I'm pulling out half of what's remaining, right? And then what I'm going to do is just use this VWAP right here and I close below it on the rest of what's remaining on that trade. So I would pull that over 400% on that. All off a 1-minute RSI divergence. Think it's something you want to use? I'm out. This SMCI, we'll see. You also want to be careful, serendipity. You don't want to build a trading system around the idea that you're going to get 400 or 500% on every option trade. Sometimes we're just fortunate and it happens, and we put ourselves in a position so that it can happen, but it's not. You don't want to build a trading system. Get close to just closing the rest of that on SMCI. I'm out. SMCI, I'm 100% out of the trade. 22 on the last piece, close to 100% on the 12s, and then almost still a little over a triple on the 6s. So it is what it is. Great trade. All right. But I'm 100% out of this trade.
So I hope that was helpful. I think it's most important to show the live trades, to also show that, hey, just because it didn't work the first time does not mean it's not going to work later. Stick with your analysis, develop a plan. You become completely unemotional. But actually seeing the live trades play out, to me, is better than me posting a trade 3 days later with an arrow saying, oh, look what I did. Look how smart I am. I don't know how you're supposed to learn from that. And the purpose of this is not to stroke my ego. The purpose of this is for people to learn, take this knowledge, and then make it their own. So I hope that was helpful. Please comment below. As always, this video is packed with information. Please share these videos, whether it's online or offline when you're talking to people. It's really important for me that people understand what it truly takes to be successful doing this and to understand who you're actually playing against. You know, you're playing against people that literally have trillions of dollars. You need to understand that. Let's talk about Apple. Now, this quarter in and of itself, I didn't think was great, but it's going to be hard for something like this to continue to drop. So what I would watch is I'd watch this DTL. Why is this going to be hard for it to drop? Because if the market's going to continue to trend higher, it's just not going to be feasible, right? It's 8% of the S&P. So you might want to watch this. Is that there? I don't know. It's kind of there. Not really. I mean, if you take this one off, what you'd want to do here more than anything is you'd probably want to clone these and then drop them down and then kind of go from there, right? See if that fits. You could argue that, rode the line, bonk, 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 right? Never got there, flips, overlay, and then see what we're dealing with. All right, so we closed over the 55 and we rejected. Maybe that's something we want to pay attention to. Maybe it's not, and then kind of go from there. I would pay attention to it solely because the market seems to be turning. You're having a macro overview as I would suggest, but there are major names out there in tech that just look amazing. Microsoft looks absolutely amazing. You really needed to get over. My concern was, do you really want to go long going into, the geopolitical events over the weekend? That was really my bigger issue. If you take a look at NVIDIA and how you held this level, it is very clear where major support is at this point. I mean, I don't think it gets any clearer that you have major support down here at 400 now. You've been building the support in this area since June. So whether or not you're in the name, not in the name, but since June you've been here and now you're back in October, all you're doing is keep talking about these head and shoulders that are going to break, and all we do is keep rallying. And now people are going to point out that we're probably going to break again. I have no idea what happens. If I was to look at this, I would want to make a higher high, but I don't know that you're going to make that higher high before earnings, which are in a couple weeks. What I would simply suggest is you just simply trade what's in front of you, look at the trade and go, okay, well, what makes the most sense? For me, what makes the most sense is looking at this and saying, yeah, this is definitely something that we can play around with. This is definitely something that we want to watch this DTL and see how it goes. At this point, you're looking for pullbacks because we're overbought and then seeing how we can get involved. Tesla was actually really weak the other day. To me, I was shocked that it went up. So again, I'm a pattern trader, but I also am a sentiment trader. And what that means is I trade the news and how we respond to the news. So when I have the UAW saying that they want to go after Tesla and they want to unionize them, and we're watching what's happening with Toyota and the battles that are going on there, I want to pay attention to that. And what I saw a stock that started to bid up. Then we started to fade. So it didn't really work. And now you're weak and you're trying to hold on to that 200-day moving average. Whether or not we can hold there, it remains to be seen. The one sector that really popped out for everybody this week that I think was absolutely glaring was one, let's clean all this off. We had a bunch of people in the room that traded this, and congratulations. But what got me about this name with ROKU was, it was not the name that I was looking for, that's for sure. But when you take a second, realize that you're now above the 55. We're now above the 200, and that's pointing up. And you're starting to see this theme develop. Take a look at Netflix. So even Netflix, you were battling that, here's the 200 pointing up, and you were playing around in here, right? You had this 12-22 cross. I use a 12, a 22, and a 55. You should use what you're comfortable with. But look how we're just riding this up the entire way. And I think that's a really important distinction. And I would be looking at this sector a little bit. If I was to look at tech, this is the sector that makes the most sense to me because you're not going to have anything. See, the problem that we're running into at semis is you just don't know what day the Biden administration is going to put new restrictions on AI chips. So we're constantly having this fear of what are you going to do today? Instead of any game plan, we're just going as the wind goes. So I'd be more interested in these kinds of names. I think they're way more interesting right now in the way that they're acting because you still have these strikes that are going on. You can see your channel, how you're breaking out of your channel and attempting to break up to that 453 level. And the amount of volume that's starting to come in these names is kind of interesting. This obviously moved on earnings. And since then, you've just really had buyers considering. You've really been even unable to break even the smallest of levels. And ROKU is just that this volume's through the roof. Does that mean you have to buy it here? No, it means that what I would do is just look for some kind of setup in this and go, okay, well, if we do turn here, let's flip that off. If we do turn here, where can this go to? Like, what are the possibilities? And I think that's a very important distinction. Now, I just want to talk about something that nobody's paying attention to. I said earlier in this video, we could say that good news is bad news and bad news is good news with the economy. It works that way until it doesn't work that way anymore. So this is one of the largest shipping companies in the world, and no one's talking about this. So we're going to talk about it. If you look at what's happening here, we just broke a new year low. So why would they break a year low if they're one of the largest shipping companies? Because you're starting to see shipping demand and demand for product come in. This is something that we have to pay attention to and be aware of. That is why the trade of the interest rates is so much more important than the trade on the XLY or the XLK. Looking at how you can benefit from what's going to happen with interest rates and bonds rallying is significantly more important than anything else because this is not dropping because the economy is heating up. This is a precursor that there may be problems down the line. Now, please comment below on this. I would like to talk about 1998, 1999, 2000, and how it's extremely eerily similar to what's going on now. And I took a couple of some of the research I started to do. It started to make me laugh. I'll just show some of it. But comment below if you want me to do this. I think it'd be extremely helpful to not only show you the similarities between where certain asset classes are right now, but people not understanding how this is going to play out. This is very clear, even from where Powell is with Greenspan, and it's so eerily similar, it makes you think you live in a simulation. But you have guys like this that were saying the internet, I predict, will go spectacularly supernova in 96 and collapse. We're promised instant catalog shopping, just point click for great deals. We'll order airline tickets over the network, make restaurants. Stores will become obsolete. So how come my local mall does more business in the afternoon than the entire internet handles in a month? Just Newsweek, this was the famous one in 95, why the web won't be. And now you have what they're talking about here, where ChatGPT that's losing customers, is the craze over? AI craze is over. Fad or business necessity, Bloomberg. So there's so many similarities, it's absolutely glaring. So comment below if you'd like me to go over this on Monday. That's it.